A very good evening, everyone. It's precisely 3 p.m. KSA time, and the time when we can start our webinar. A very warm welcome to all the participants joining the webinar, wherein we will be talking about the actual valuations of end of service benefit. Thank you, everyone, for trusting the team KPAC with your valuable time. In terms of the agenda for this webinar, we will begin with talking in length and breadth about the actuarial valuations of employee benefit schemes. And then we will discuss how the actuarial valuations can benefit the management, plus the role that the management can play in successful enablement of the actuarial valuations. We will also talk about the different type of employee benefits that organization can offer and their actuarial valuation requirements. We will then look into the actuarial valuation process in detail, talking specifically about the data, assumptions, methodology, and how to read and interpret the actual valuation results. Post which, we will conclude the actual valuation process by summarizing the role that the different stakeholders can play to the entire valuation process. This will then be followed by an update around some recent trends that we have been observing in the market, particularly around the discount rate movements that we have seen over the last 1 year. And lastly, we will look at some of the common audit queries which we generally encountered from the management and the auditors post the submission of the valuation reports. So we will start with what is an actual valuation. See, the actual valuation is a financial assessment that estimates the future cost of employee benefits. In simpler terms, it is a way to calculate the present value of future payments to the employees using certain actuarial techniques. One of the most commonly applied actuarial techniques is the use of decrement tables, or in simpler words, we can call it as a survival probability table. This involves estimating the probability of the future benefit payouts. And I'm sure all of you had discussion with your actuaries around the attrition rate assumptions. So the objective here is the actuary use the attrition rate along with the mortality rate to derive the survival probability table, and the application of this probability table is used while evaluating the financial obligation of the organization towards the employee benefit schemes. Now, there are different type of actual valuations which can be performed to an employee benefit scheme. First one is the funding valuation. The purpose of the valuation is to determine the level of the funds required to maintain the scheme solvency. Second is the buyout valuation, wherein the objective is to determine the price of securing the benefits completely with an insurance company. And the third one is the actual valuations for the accounting purposes, wherein the actuary assists in preparation of the accounting disclosures, which includes the necessary disclosure related items which are required to be produced for the financial assessment statements or the annual reports of the company. So, when we particularly talk about the accounting disclosures are prepared under the various accounting standards, such as IAS 19, Section 28 employee benefits for small and medium sized entities issued by the Saudi Organization for Certified Public Accountants, as well as the US GAPs. The principles for determining the actual liability is same under all the accounting standards. Therefore, the actual liabilities remain the same under all the accounting standards. But what differs between all the standards is how the expenses are recognized and how some of the items are disclosed in the valuation reports under the different accounting standards. Now, given the financial year end 2024 has been ended, and I'm sure a lot of financial professionals are already looking for the closure of books for financial year 2024. So, here we will primarily focus on the accountant related actuarial valuations. So, in this slide, so in the previous slide, we look at the features of the actual valuations, which is performed for the accounting disclosure purposes. So the key features, first, it provides the true and fair value of the scheme financial positions. Means both the assets as well as the liabilities. These are marked to market. The actual liability valuation is performed using the market link assumptions, wherein the discount rate adopted for the valuation is marked to market, and the assets are taken at the market value as of the balance sheet date. So the valuation provides a true and fair value of the scheme financial position. Secondly, the accounting valuations are performed using the assumptions which are unbiased. It means the assumptions which are used for the valuations are neither overprudent nor underprudent. Using the unbiased assumptions means it helps to recognize the realistic cost. That is, the cost is determined as what it should be because the actual liability ignores the element of the prudency. Now, the question is, why is the realistic cost assessment is important? Simply because of a fact that the valuation results are presented in the annual reports and accounts, and it forms a useful disclosure related items for all the stakeholders, such as shareholders or investors or other users of the accounts. So it helps all the stakeholders form a real picture and assess the company obligations towards the employee benefit plans. Lastly, the accounting standards are mostly prescriptive in nature, which means the accounting standards prescribe the valuation methodology to be used and how the assumptions must be determined. So, this prescription ensures that the organization adopts a consistent practice year on year, as well as it ensures a consistent practice is followed by all the companies across the entire industry. Now, given that we have already looked at some of the key benefits of the actual valuations, we will now look at how these valuations can benefit the management. Access to actual valuation reports provide a very good understanding on the nature of the liability profile. That is, the actual valuation reports disclose what is the expected timing of the benefit payment, what is the magnitude of the corresponding payment, and how much of the liability is expected to fluctuate due to variation in the key actuarial assumptions. Now, when the management has access to all such informations, it helps them in making a lot more informed decisions and help them in determining the suitable investment strategy for their employee benefit plan. Given the organization has access to such a quality of information, the organization can certainly adopt a well suited asset liability matching investment strategy, which is also extremely useful for the risk management purpose. Because such strategy allows and ensures the market value of assets as well as the marketing liabilities, these move in sync with each other. Now, such a strategy also ensures that the employee benefit plan will have an access to the adequate cash or cash equivalent to make the benefit payments as and when the benefits become due. Thereby, it helps the organization in managing the liquidity risk. Such a strategy also helps to hedge the liability movements against any fluctuations in interest rate, which is a key financial assumptions. So this way, it will help to protect the scheme funding position and also maintain the net balance sheet position, because the net balance sheet position will then more or less remain unaffected. Further, the management also have an option to have the valuation results under the range of valuation assumptions just to understand and determine the affordability as well as the feasibility of the benefit plan, particularly under the extreme circumstances. Now, the access to such information is extremely useful to determine if the management can afford to offer the more generous benefits, which may eventually lead to a better employee retention, or it may also identify if there is a need to further optimize the benefit plan, considering the regulatory restrictions. Thus, the access to all the information which the actual valuation reports and results provide, it helps the management to make several decisions in a lot more informed manner. Lastly, the actual valuation disclosures also ensures the organizations are always on the right side of compliances and thus satisfying all the regulatory requirements also. Now, given that we had a look at how the valuations can benefit the management, let us quickly look at the role the management can play in order to ensure the successful enablement of these actuarial valuations. Firstly, the management must maintain the accurate individual employee data. The individual data could be date of birth, date of joining, or salary details. Secondly, the management must also regularly collaborate with the actuaries on some or maybe all of the following items. Setting the actual assumptions, in fact, the management will have a greater insight about what is happening within the organization. So they must regularly communicate with the actuaries around what assumptions could be look like in future. For example, the future expected salary growth rate or the iteration rate. Again, we will be discussing all these key actual assumptions at length in the actuarial valuation process. They should also regularly discuss the actuaries regarding the developments in the markets. For example, how is the interest rate behaving? Or if there is any regulatory updates that are happening around the industries which can possibly affect the valuation results. So the regular collaboration with the actuaries can help the management to understand what could be the possible impact on the liabilities and what could be the possible impact on the expenses. And the management should also understand the possible financial implications on the scheme as well as on the company if any of the employee benefit would be funded either in advance which is via regular contributions, or if they are funded as and when the benefits become due. Lastly, the management must also take the responsibility to ensure adherence to any prevailing regulations around offering the benefit plans. And they should also ensure the disclosures of all necessary items in the annual reports of the accounts.